Martin Pring, and thanks for dropping by for this outlook perspective on the second half of the year. First of all, I think we're going to see a growth slowdown ahead, but not a recession. And this growth slowdown is just merely a slowdown in the growth rate of the economy. And it does sometimes affect markets in the sense we get a correction in the stock market, or we get a correction in the rise in yields in the bond market and so forth. Number two, the secular and primary trends are bullish for US equities, but don't be surprised if we get a normal 5 to 10% correction along the way. Commodities are still bullish in a primary trend sense, but look for a correction sometime in the second half. Well, this first chart shows us the ECRI, or weekly leading indicator, and underneath is a price oscillator where we'll compare the weekly close to 180-day moving average. The point here is that the indicator has reached a plus 10% reading. And in the past, this has been sufficient to bring on some kind of a correction in the leading indicator itself, and therefore the economy, as you can see from this chart here. And we also see that the last few weeks, we've got up to that 10% level again. Now, when I think this is going to indicate a slowdown in the economy and the growth rate, I don't think it's going to mean anything in terms of a new recession. So this is our Pring-Turner leading economic indicator. And underneath is what we call a recession caller, which is really a glorified price oscillator. And when it crosses that red line at the bottom there, that indicates that a recession is probably underway. So the recessions in the chart are indicated by the red highlights, and that red line there is called the recession line. So when we line up some arrows with the beginning of a recession, as we have here, or beginning of all the recessions there, you can see that as the recession begins, typically the indicator is crossing below the recession line. Right now, it's way above that recession line and certainly not even close to triggering some kind of recessionary signal. So let's start off with bonds. And we'll look at the secular trend. This chart here plots a series which splices 20-year bond yields to the 30-year bond yield, because the 30-year bond yield doesn't go all the way back to 1860. But we've got a nice track record of how yields have performed over the last 150, 60 years or so. So as you can see, they tend to move in these long-term waves, which we call secular trends, which encompass several different business cycles. And the idea is really to try and determine what the direction of that secular trend is. Is it up or is it down? And one of the ways in which we do that is to compare the two moving averages in the bottom panel. So when we get a red highlight up here, it means that the 9-month exponential moving average crosses below its 96-month exponential moving average. And that triggers a sell signal. And then when it crosses above, that triggers a buy signal and a green highlight. One of the things I like about this model is that it catches the turns fairly closely to the final turning point, which is important. But also there aren't too many whipsaws here. In 160 years worth of data, we've got 1, 2, 3, 4, 5 different whipsaws. Not too bad at all, really. Another way in which we can monitor trends, secular trends, is to draw some long-term trend lines. And here you see we can draw one from September 1981, when the secular bear market yields began, all the way down to the current picture, or the current data, and we see that that downtrend at this point is still intact. One of the things I've noticed about reversals in the secular trend of bonds is that there's usually some sort of a trading range that takes place over maybe a 12 to 14-year period. And when that trading range is violated, that's kind of another signal that we've got a secular reversal underway. Well, right now, of course, we've had a sharp down move in 2020, sharp up move again, late 2020 to early 2021. And there's really been no trading range. So I would envision before this thing begins to reverse, that we'll see some kind of a trading range. And I've put a sort of a hypothetical example up there. It's not certainly not a forecast, because no one can predict that kind of stuff. All I'm saying is that it would be surprising if we got a secular reversal and it went straight down and straight up. That's not usually the way it happens with the bond market. It could, but it would be the first time. So we're looking at the possibility of a second reversal sometime in the cycle. But now we'll take a look at the primary trend. So here's the 30-year bond price. And you can see the secular trend has been intact since the 1990s, zigzagging its way up. What's important, though, is that business cycles can be split really into two parts, an inflationary part and a deflationary part. And in this chart here, we have an indicator that compares an inflationary indicator, bonds, to commodities. So we take a ratio between bonds and commodities, which is a deflation-inflation ratio. And when it starts to turn up, that indicates we're the inflationary part of the cycle. So rather than use the raw data, what we do is we calculate a KST. And if you're not familiar with the KST, it's a long-term smooth indicator, similar to to a smooth stochastic or an MACD indicator. What we've got is the raw data expressed as momentum, and when the momentum reverses direction, that gives us an inflationary or a deflationary signal. So here's the deflationary signals, and you can see that even though the basic trend was up, it caught most of these signals because they were counter-cyclical in nature. Didn't give us much of a magnitude on the downside because there wasn't on any of these declines during the secular uptrend, but it did give us some indication that we were going to get some kind of a cyclical correction. And you can see we get this all the way up. And then the other side of the equation is the buy signals, and they give us a lot more magnitude because each of these signals is going in the direction of the main trend, which is the secular trend, which is an uptrend in prices and a downtrend in yields. Right now, that indicator, or I should say earlier, late last year, it gave us a sell signal, pretty timely, and now it's moderately, I wouldn't call it oversold, but it's reached it's below zero. So it's probably had most of its magnitude on the downside at this point. Also, the secular uptrend is still intact. Is another way of drawing that secular trend line we looked at in the previous chart. And it's a nice line because it's been touched or approached on numerous occasions, and did experience a small break just here in 2018 or so. And as so often happens with whipsaw signals, people get very bearish on the breakdown on the downside. And then when they realize that they're on the wrong side of the market, they have to cover those short positions or get back long again. And that often is followed, a whipsaw is often followed by an above average move in the opposite direction to the whipsaw. So in this case here, the opposite direction was an uptrend. Now we're looking at the 20-year yield with a 12-month rate of change. What we see is that the 12-month rate of change has reached an extraordinarily high level. Usually when it reaches a high level of 40%, when it reverses direction, we see some kind of a correction in the yield itself. In this case here, though, I can take this indicator all the way back to the 1930s, and this is a record high indicator. And typically what happens when we get to one of these huge swings in momentum, it reflects a huge swing in sentiment. In this case here, it's an indication that or one piece of evidence that the secular downtrend in yields has reversed, because you see this huge upside momentum move. It also comes with a price, because overbought conditions are usually followed by some kind of a correction. So while this in one sense is a very positive signal if you want to be bullish yields, on the other hand, it's saying that we should expect to see some sort of a correction take place along the way. And that correction may be underway now, because we see the 10-year yield, and it looks like it's forming a reverse head and shoulders here. Underneath is a credit spread ratio between the iBoxx high yield ETF, the HYG, and the 20-year plus yield, the TLT. And this ratio tracks the 10-year yield quite nicely. The ratio itself is below this long-term downtrend line going back to 2011. And every time it's hit the line, we've had a correction in yields all the way through. So we've had that 3 times that's happened. And it also looks as if we're getting a correction in yields right now, because the intermediate KST has started to turn down. And even so, it does suggest that some corrections on the way, or it's already underway. But the long-term KST in the bottom panel is still going up. So we're saying there's going to be a correction in under the context of a primary bull market. So that correction is probably going to be quite limited, but also part of that trading range we talked about, or possible trading range in that reversal of the secular trend. Now we look at stocks, and here's the MSCI World Stock ETF, and underneath is a moving average volatility indicator, or MAVI. What this is a combined indicator that combines 4 different price oscillators using different parameters into one indicator that weights the lengthiest parameters with the biggest weight and the shortest parameters with the shorter weight. And so it's able to follow the basic waves in the world stock index. So the idea is we get buy and sell signals when it comes down, comes up, and then crosses above its moving average again. So I can put those in. You can see that each of these signals was followed by a nice rally in the stock market, a very long-term rally in the stock market. And we got a buy signal very recently again. Also suggests things are going higher here. On the by the same token, we can put these arrows away, and you can see that the index crossed above this resistance trend line some time ago. And if you take the indicated upside measuring objective, that calls for a doubling in prices, because the index right now, or the ETF right now, is about 100, 101. And that line takes you a little bit above 200. So that again suggests that we're going to see higher stock prices over the long haul. Now we're looking at inflation-adjusted stocks compared to the Shiller price-earnings ratio. And the Shiller is a cyclically adjusted price-earnings ratio. So it takes out a lot of the short-term moves in the cycle. So the idea is that I look upon it more as a sentiment indicator than as a fundamental indicator, because like you take 1929, when the ratio was up to $31, that tells you that people at that time were willing to pay $30 for every dollar's worth of earning. So they had to be pretty optimistic at that point if they're willing to pay such a huge amount for earnings, a dollar's worth of earnings. Yet in 1932 at the bottom, sellers are willing to liquidate at $5 per dollar's worth of earnings. So again, the psychology changed tremendously. So the Shiller PE is very useful in terms of identifying peaks and troughs in the secular trends. But right now, as you can see here, the latest data at 37 is at a record level, apart from this period here in late 1999 to 2000. So it's at a very, very optimistic level. So that makes it moving into dangerous territory. But on the other hand, I think that the thing which trumps the level of the indicator is its trend. And it's been possible in the past to draw trend lines on the Shiller price-earnings ratio. When those trends, remember these are trends in psychology, get broken on the upside, we get a nice rally in the stock market, a nice secular advance. Well, it's possible to draw another trend line here, an inverse head and shoulders, and we see the breakout take place. And that suggests that as long as that trend is going up, even though it's at a dangerous level, prices themselves are likely to go up too. And that's quite a long-term trend line. Now, on the other hand, it is coming from a much higher level than these other trend lines. So obviously it would suggest that the trend is not as sustainable as some of these others. But it does tell us that in the immediate future, things look pretty positive in terms of the trend. And also another thing we can look at from a point of view of seeing a reversal is a negative crossover of this 48-month moving average. And it's clearly quite a way above that at the present time. Now we're comparing the S&P Composite to the University of Michigan Consumer Sentiment, and there's a bit of a correlation between the two series. But the consumer sentiment indicator is so jagged that it makes it very difficult to analyze in its raw state, which is why we calculate a smooth momentum, or a KST, for this indicator in the bottom window. And the idea is that when the KST comes down and starts to turn up again, that's very bullish for the stock market. And you can see that we have 2, 3, 4, 5, 6 indicators here, or 6 signals, and each one was followed by some sort of a rally in the stock market, a nice rally too. And in the current situation, you see that it's only just started to turn up, which is quite positive. Now we're looking at the S&P with a 12-month rate of change. And the idea is that the 12-month rate of change has moved up to the 50% level recently, which is where that green line is. And in the past, when it's reached that level, again, it's kind of like that 12-month rate of change for the bond market I showed you earlier. It indicates usually an important change in psychology, lots of strong underlying upside momentum. So the good news is that when it reaches plus 50, that's usually good for the long haul. But over the intermediate haul, it's sometimes due for a little pullback here, and we see another one over here, just a slight one. So the good news is that it's reached plus 50, which indicates the stock market has tremendous underlying upside momentum. And the negative part is that does sort of suggest that we may be in for some kind of a temporary pause, a 5 or a 10% correction. What we don't want to see, though, is it reach the 50% level like it did in 1929. And that, of course, was followed by the most devastating bear market in history. But that reading followed a multi-year advance in the 1920s, whereas this one here that we're seeing in the current situation followed on top of a big shakeout, 30% shakeout last year in 2020. So it's not quite the same thing. One indicator I'm watching or relationship I'm watching very closely right now is the relationship between the S&P and gold. The S&P, of course, represents, when that's going up, it represents people have a lot of confidence and they buy stocks for the growth potential and the dividend payouts, so to speak. Whereas with gold, it tends to move up higher when people are smelling trouble or instability, such as unstable rates of inflation and so forth. Well, in the past, you can see that there have been three major trends in the past, starting off in 1972. There have been three major trends, two down and one up. And another one has been an uptrend has been underway since 2011. But now that ratio has rallied all the way back to this resistance trend line just here. If it goes through, that would suggest that stocks are going to outperform bonds for quite some time to come, because that's a major trend line. It goes all the way back to 2005. Also, we see that it has just experienced a long-term KST signal, and those signals in the past, as you can see from these arrows, have been pretty good. They've been followed by a nice rally in the ratio, so they've been a reliable indication that the ratio has reversed on an important basis. There's one exception here where we had a very small rally, and then another one here. I didn't put it as an exception, but it wasn't. It was only about a year that the ratio rallied. So anyway, we're watching this very closely, because if it breaks to the upside in favor of stocks, that would not only be bullish for the stocks relative to gold, but this next chart shows you that will be bullish for the stock market as well. As you can see here, the green shadings, with using the benefit of hindsight, indicate when you've had a rising trend of the ratio. And here's another rising trend just here. So when you look at what happens to the stock market also rallies when the ratio rallies, or has a tendency to rally. And if we're going to get a bear market, it tends to be when this ratio is in a bear market itself. So that's a positive thing if we can see the ratio break above that trend line I showed you in the previous chart. So now we'll take a look at commodities. And here's the CRB Spot Raw Industrials. It's a purely industrial trade-driven index. Doesn't include a lot of speculation, doesn't include much in the way of, or anything in the way of weather-driven commodities except cotton. So it's very economically sensitive. And this chart starts in 1900 and goes forward to the current situation. And underneath is our secular oscillator. That's where we divide a 60-month moving average by a 360-month moving average, a 5-year by a 30-year. And when that bottoms out and crosses above its 48-month moving average, that gives us a signal that the secular trend of commodity prices is an upward one. And you can see that the secular bear markets have sometimes been severe, like they were in the 1920s and early 1930s. Or more likely, what happens with a secular bear market is it transitions into a secular trading range. Be that as it may, this indicator here, the secular oscillator, has started to turn up here. Hasn't quite crossed above its moving average, but usually when it reverses, it's probably going to do so. So this is what we're on the lookout for, is the possible reversal in a secular uptrend. And it's a question of whether we can get some more cyclical strength, which allows that this indicator to start to turn again. Also, in a super cycle sense, we've seen a very, very long-term uptrend in commodity prices. And you remember what I was telling you before about whipsaws being followed by above average moves. So here we see two whipsaws below that trend line. That was certainly followed by an above average move. And the one that took place last year has also so far been followed by an above average move. So this is one of the reasons why I think this commodity bull market has got legs, is because we've seen this whipsaw signal, and we haven't really seen that much of an imbalance, say, compared to this one here, or compared to the bond chart that I showed you earlier. When we look at commodities relative to the economy, a good indicator is the ISM new orders, and we take a PPO of that using the 12 and 26 month parameters. And the idea is that when it gets oversold, overbought, and starts to turn, that's time to get worried about commodity prices. Well, right now it's getting overextended. And you can see in the past when it's got overextended and started to turn, that's been negative for commodity prices, except for this one instance in the super bull market that we got between in the early part of the first decade of the current century. So right now the trend is up. I'm not going to say that it's going to turn. I don't know when it's going to turn, but it could potentially have some time left in its uptrend. We'll have to wait and see, but that's something we're watching very closely, because sometime in this second part of this year, it may show some signs of reversal. At this point here, the CRB spot row industrials is also running up against resistance. So that this will be as good a place as any for expecting a reversal if it's going to take place. Money supply is an important thing to look at, because we think of M2 as being a fuel for inflation. But there's very little in connection. When I take a 12-month rate of change of the money supply and compare it to CRB spot row industrials, there's not much of a connection. One small connection I can point to is the fact that when the indicator peaks out, when the rate of change peaks out, that's often been associated with commodity price bottoms, cyclical lows. But that doesn't happen in every cyclical low, and you also have the problem of finding out when the indicator reverses. So that's not of much practical help. Another thing is that if money is created, the faster it moves around, the more inflationary things become. Well, look what happened to M2 velocity. It halved between the beginning part of the century or late part of the last century and the latest month, from around 2 to about 1.1. And commodity prices basically doubled in that same period. So there's really no connection between M2 velocity and commodity prices. However, if you adjust M2, the raw data, with the velocity, you get a very, very interesting indicator, which I plotted in the next chart. This is the velocity adjusted M2 KST in the lower panel. And the idea is that when it reverses direction, you can see that it catches virtually every major commodity market bottom that we've had since the 1940s, because this chart goes back to 1943. And then when we look at, you also see, because nothing is perfect in this world, we see two subpar signals, but they were quickly reversed. But they didn't amount to much in terms of a cyclical rally, obviously. And then we can look at the sell signals. They also were pretty consistent here. And again, we get two exceptions where we had the super bull market in the early part of the century and not much of a correction. So in summarizing that, there were 17 buy signals, 15 of which were valid and 2 of which were invalid, and 16 sell signals, 14 of which worked and 2 of which were false negatives. So that, to me, that's a pretty good track record. So right now, that indicator is looking a little bit overextended, like the other indicators for commodity prices. But it does, I have further to go in this, because when you look at this chart here, or this trend line here, it's a neckline of reverse head and shoulders, and you take the measuring objective, and that puts the price objective up to something like 750, maybe a little bit less. So that suggests to me that commodity prices are probably going to continue to move higher here after they've gone through some kind of an intermediate correction here. So here's the CRB composite, which includes weather-driven commodities. Of course, it's much broader based than the CRB spot raw industrials. broken its secular trend line, which began in 2008. It's made a decisive break above the line. And it's also crossed above its 12-month moving average, of course. And it's broken above its previous high, all of which suggests that commodity prices are going higher. Underneath is the opposite of the ratio that we saw for the bond market. We saw there the bond commodity ratio, deflation, inflationary. Now it's inflationary, deflationary, with commodities divided by bonds. And that's the KST once again. And here again, we see the nice buy signals that have taken place, and they pretty well all, except this one here, been followed by a very worthwhile commodity rally. This one here was a bit questionable too, because remember, it was a counter-secular signal. And here are the sell signals. So once again, we're in a situation where it's moderately overbought, and we have to assume that that trend is going up until it starts to reverse. So that's something well worth monitoring going forward into the second half of this year. And there's two signals that didn't work. And unfortunately, I've yet to find the perfect indicator for any market. But if I can get 4 or 5 or 6 to 1 ratio of signals working, I'm very happy with that. Now we're looking at the continuous copper price, and underneath is a special K indicator. So the idea is that the special K combines the short, the intermediate, and the long-term KST into one indicator, and it has a tendency to peak and trough along with the price series that it's monitoring. In this case here, we're looking at the continuous copper price, and I put these arrows in here to kind of line up with the major lows, and these arrows to line up with the major highs in the copper price right now. And one of the things that we're watching is when the copper price or the special K crosses below its signal line, that would indicate that we've probably seen a peak in the special K and probably seen a peak in copper. Right now, though, copper is backing off this resistance trend line. It's above its 200 moving average, and it's above a lot of other long-term moving averages as well. So it's obviously in a bull trend. But it wouldn't be surprising to see copper experience some more corrective activity, reaching this resistance level. So it's just something to watch carefully in the period going forwards. So it's still above the signal line. Another key commodity is oil, and here's the West Texas sour. It goes back to the 19th century, and we got that a secular price oscillator we had for the CRB spot raw industrials. The idea is that when it crosses below its 48-month moving average, that signals a secular bear market, which in this case here, and many of these cases, turn out to be a secular trading range. And then we get the buy signals as well. And they are followed by nice rallies in commodity prices. You see it bottoms out here, it gets our signal, and then we get a nice rally. And at the current time, it's starting to turn up again. It hasn't quite crossed its moving average. It's a little bit of an anemic reversal at this point, but we're watching it very, very carefully. We can see that the oil price is running into resistance here. So it's at a pretty critical level. I can take this down to finer detail by looking at West Texas Intermediate, and we can see here that it's right again at the important resistance line, and also right back to its previous high, maybe edged slightly through its previous high. And the long-term KST is in a bullish mode. What happens when we get a bearish signal? It's typically followed by some kind of a decline in the price. So that's something I'm watching for, as if the oscillator starts to turn down as resistance becomes too great. But right now we're looking at oil and a solid uptrend. I would imagine it will get a little bit of a correction and then move higher. Well, that exceeded my time a little bit, I think, so I'm going to wrap up now, and thank you very much.
Hey guys, Dave Keller here with StockCharts.com. Thanks so much for watching our video. If you enjoyed it, and we hope you did, hit the like button right below. Also, we have so much new content every day. Consider subscribing to the channel. Just hit the subscribe button in the video or right below. Thanks for watching. Stay safe. Have a fantastic day.